Okay, cool. We're live. And what we're going to do today is talk about risk and things like that. So that is on the agenda today. So just verify everything is working. It looks like we are connected. So it is all good. All good. Okay, so let's get straight into the lesson. Let's talk about risk. And we're also going to talk about market efficiency and things like that. So, okay. Now, risk essentially is uncertainty. So, yeah. So it's uncertainty. Cool. Yeah. So what that means is in terms of assets and stuff like that. So, for example, imagine if you had a contract, right? And you buy this contract for $1, and then it pays you later. It pays you later, maybe, I don't know, it pays you $2 later, right? And no matter what happens, you always get that $2. This is what we call riskless. So risk is just something that's not riskless, right? So somewhere between here, you paying this and then you getting your $2 here, there's some sort of doubt or uncertainty that you won't end up getting your money in the end, right? And so what we do is that we try to formalize and make some mathematics about the risk, right? And a very important thing, I think, is this idea of expectation. So, expectation. So this isn't going to be too formal. We'll get into it later. But a whole thing about expectation is that it's a way of taking all possibilities and all their probabilities and summing it into one number. So essentially, let's say you've got two possibilities in the world. So maybe you're playing a game, right? And the game is you have to buy in. The buy-in is $50. And if you're successful, let's say a dice roll. If it's even, you get $100. But if it's odd, you've lost your 50. You've just say lost your $50, so you have negative 50. So let's just say, yeah, you either get $100 or it's going to be negative $50, right? So, how we calculate expectations, just in general, is that, okay, so we say the expectation of event X, so this is a random variable here, is just going to be the sum of like the probabilities multiplied by the value. So let's unpack that just a little bit. Now the value is just this and this. So we plug those all in there, and then for each of those situations to happen, so if the dice is rolled evenly, it's going to be a half, and if it is rolled to an odd number, it's going to be a half as well, right? So doing this calculation, it's just going to be 100, and the probability of getting 100 is a half. And then the other event, so remember this is a summation, that's why we put plus there, is just going to be 50 times a half. Cool. And so if we end up doing that calculation, so we can factor out the halves there, and then we've got 100, take 50, and so that's just going to be half, and then 50, which will just be 25. So this 25 is greater than 0, so it's a positive expectation. So if I said to you at the start, I propose this game, right? The buy-in is $50, but if you roll even, you get $100. So you're expected to win $25, right? Just on average for each round. So that is a game I would play. And that is sort of a very, very basic way of formalizing risk of assets and stuff like that. Now, let us make a, what was it? Oh, wrong one. Yes, here we go. Let's make a new page. Oh, document is not saved. Oh wait, cancel. How do we? New page. There we go. That's what we want. Great. I'll just make that a bit bigger. Cool. That's great. So that's risk. That's risk in a nutshell. And so you've also got degrees of risk in the financial world. So you've got so I think the one of the least riskiest things is something called bonds, right? So a bond is like a contract, either a company or government would issue, and so here we'll denote this by this little thing we're going to draw right here, right? That's a bond. We'll call that a bond. And so how this works is you will pay some money to buy this bond. So this is you. And this is your cash, and you make a swap right there, and now you own the bond. So you own the bond. So maybe you own the bond, and say the life of the bond is 30 years. So 30 years. So what will happen is that you've got this bond, and then over every few years you get some money. So you collect some money, you collect some money, you collect some money, right? Some money, and you collect some money. And then at the end, you usually just get all your money back, right? At the end. So, why would a government offer such things? Why would a government offer such things? Because it seems like it's not a fair trade, right? Because you essentially you buy something, it gives you money, and then you get your money here. Or even so I'll explain what's going on. So essentially, say this is America, right? Like, the USA, and they issue this, and so what's their advantage? So essentially, the America will collect your cash up front, because they may need that for something. Right? And so they can invest that in other things that may produce money on their end, right? And so if they invest that in other resources, mining, who knows what the government invests in, like these payments here, they're offset by the investments the government makes here. But there is actually a risk. So there's this thing called default, right? Default. So what default means is that you have this bond, and then at the end you can't end up paying the dude his money back, right? So that's your risk. So you risk taking on like the country defaulting on their bond. So but that's probably unlikely, especially if you're dealing with a country like the US or something like that, USA or England, or like a more first world country. But if you buy bonds from maybe a riskier country or something like that, you are sort of going to be more at risk, of not getting your money. So often, if for example this is like country, a risky country, often the premium of the premium of the bond will be a bit cheaper, right? So because the risk is higher, and you won't end up getting your money back there. Anyway, so that's a bond, and that is usually quite riskless. It's very secure, very safe. Now let's talk about sort of more riskier assets. So a risky asset would be like stocks, right? Stocks or crypto. So why are stocks and crypto sort of more risky? So essentially, you can think of it as stocks, right? They're risky because you won't necessarily, so the company could default, so that like the price of the stock just goes to zero, the company goes bankrupt, and then so let's say you buy the stock at $100, right? So you have $100 worth of value. You buy one stock. Now, the probability that the company will sort of go to zero or the company will fail that's going to be higher probability than a country defaulting on, a country defaulting, right? So that's why a stock is more risky, because over time this, like, yeah, if the company just defaults, like the value of the stock will just go to zero, and then you lose your money, right? But with risk there's also a bit of reward. So there is the possibility that the company does well and maybe the stock price shoots up to 150. And then you would have made money in that situation. Now, if we look at the bond situation here, there's no such thing. It's either you buy in here, and then at the end you're gonna get these fixed payment depending on the interest rate, right? Which the interest rate doesn't change as much as the price of something like a risky stock, right? And you're sort of gonna get a more guaranteed amount of money by the end of this 30-year period, which is long. Looking at the stock, this might actually be like a 1-year period realistically, and so we say it's more risky because it can go to zero, but honestly, with risk comes higher returns. And then crypto is sort of the same thing, but it's more likely, something's at 100, and then in one day, in a day instead of a year, that could go to 200, or like maybe it's a pump and dump scheme, right? If you've heard of those, and this it just goes to zero in 1 hour. Okay, cool. So that is sort of all I want to talk about in terms of risk. Does anyone have sort of any questions before I move on to the next thing? I want to talk about something called the efficient markets. I want to talk about efficient markets. Does anyone have any questions while I'm doing that at the moment? Otherwise, I'll move on to this concept of efficient markets. All right. Okay. No. So let's move on to efficient markets. So what an efficient market is it's the concept. It's the idea that you have an asset, like say you've got Bitcoin, and Bitcoin is trading at some price, and the idea is that all the price data, all the information about Bitcoin is embedded in the price. So essentially, you can't really like look at the price and try predict future outcomes or something like that, or there are inefficiencies you can take advantage of, because everything, all the information, all the valuation, all the like crazy stuff in the world about Bitcoin, it's already baked into the price, so the price is already fair. But I think the nuance here is that it's not entirely true. So it's only true if everyone in the population believes such a statement is true. So a good example of this is, right, imagine you're walking on the street with your friend here, and then you spot $10, right? That's a $10 bill in the gutter. And so the analogy is going to be like, okay, I'm not going to pick up the $10 note because all the price is baked into the $10 note. So therefore, there's really no point in picking it up. And then this is also leading to the idea of just being first in the market. So what happens is you know, one person believes that the price is like the price and information is baked into the price of the asset already, so he's not gonna pick the undervalued thing. But the other guy, he might just pick it up, right? He picks it up, so you've just got $10 of value there, and this guy actually picks it up, puts it in his pocket, right? And then the market becomes sort of neutralized or equalized because there shouldn't be a $10 note lying around. Like you just have value there. And so it's really the first person that sort of brings this market into, you know, this market efficient hypothesis true, right? So it's more about a belief thing in being first. So let's relate this sort of back to Bitcoin, right? So imagine you're Bitcoin, and so for example, you see news about Bitcoin or something like that, and then you're the first to see it, right? So you think the price of Bitcoin is undervalued, so you know it's trading lower than what it should trade, and you're the first one to sort of see that. And so what you do is you go ahead and you buy the undervalued Bitcoin first. So you've got to be quick. So you buy it first, and the fact that you bought it actually will push the price up. It'll actually push the price up, and then it will not become undervalued anymore. Just because you bought it, by you observing it, you interacting in the market, the fact you bought all the undervalued stuff, by buying it, you increase the price of the asset. And then once you've collected all that like value, sort of that free value in the market, you've taken it, then it becomes, you know, then it sort of neutralizes itself out, and you've extracted all the value. And sort of the slower people to it, then yeah, they're suffering from that market efficient hypothesis thing because they were just a bit too slow to react, right? Now, so that is sort of the fair world, and what you're doing here is, in this situation, you're reacting to publicly available information, and you were just the first. Now, there are other ways to sort of take advantage of such things, and usually that is you know, illegal. It's just insider trading. So insider trading. So say you want an informational advantage, right? You want some sort of extra info, and so the extra info will either say, okay, this is overvalued or undervalued, and you'll either buy or sell before everyone knows about it. And honestly, the most common way is this so-called insider trading, which is it's not extreme, it's just illegal. So don't do it. But it speaks to the idea that having information that everyone else doesn't have is actually a very powerful thing, and will sort of set you apart from all the other traders. In fact, it's so powerful that the whole idea of insider trading is just illegal. So you don't do it. So you don't do that kind of thing. But yeah, so that is another way to get an informational, you know, edge on things, but it's just illegal, and you shouldn't do that. So okay, you're wondering, okay, how do I get informational edge? It can be quite hard sometimes. So you've got news, and you sort of see the news before everyone else. Honestly, these days it's tech. It's really tech. So imagine you have one short-term traders use, one that I've used before, is that you're trading Bitcoin again. Now you have a big exchange. So let's say Binance, right? Binance, and you are trading on a let's just say smaller exchange. Now often there's a phenomenon, right, where everyone is looking at Binance for the market price, but on the smaller exchange, people don't trade exactly at Binance's price, so it might be a little bit overvalued or undervalued because you need a bit of time to catch up to the market on smaller exchanges, right? So what happens is this is called arbitrage. So maybe the price of Bitcoin on Binance is, let's just say, I don't know, 100,000. And then the price of Bitcoin on the smaller exchange is 90,000, right? So this is called arbitrage, right? And the way you do it is you connect, like, have two WebSocket connections for the exchange, and then you monitor it and then buy and sell where you need to. So how it works, okay, so here you've got the cheap option and here you've got the more expensive option. So this is what you do. So you would buy here really quick. You'd buy here, and then you take the BTC. How was it BTC? The symbol for BTC. You take that, so however much BTC, and then you would sell it. You'd sell it here. So you'd make, and so you bought it here for 90, and then you sell it here for 100, and so you've netted a profit of 10k, right? And so by doing this thing, what happens is you're actually, every time you do this, you actually slightly drive the price up. You drive the price up, and then here by selling it here, you'll sort of drive the price lower and lower, and then that it will sort of eventually meet in the middle. Because this has more volume, it's more likely this on the smaller exchange, the price will go up more, as opposed to this coming down, because there's more volume here on this exchange. And so, you know, what will end up happening is it'll go to 95, and then it'll go to, like, you know, 97, and then so the arbitrage, so you make less and less money. So maybe you'll make 5k here, and then you'll make only 3k on one trade, and then eventually you'll end up making 0 because you've extracted all the market value there. Okay, cool. So that is a little stream on risk, arbitrage, all that stuff. Now I think I'm going to end it, just keep it short, 30-minute stream. So is anyone confused? Any questions? Anything at all? I'm happy to answer anything. While people come up with some questions about risk and all that stuff, I am just going to show you my my school community. So I run a school community, and what we do is we teach coding and trading and things like that. So if that is something you're interested in, I'd love to help you build a automated trading system. Essentially, that's what we do. So we give you the coding knowledge specifically for finance and trading. So, you know, we're not particularly focused on showing you how to build websites. We want to get you up and running as soon as possible. So what does that involve? So that means understanding how WebSockets work, so you can stream Bitcoin data, or understanding how to interact with APIs so you can make trades between exchanges and things like that, or understanding logging. So that's very important, because when you log things, you're able to see what price you got in, what price you got out, or perhaps the exchange went down, and when you can reconnect, and understanding all that kind of stuff. So all that stuff, and then we give you all that knowledge, and then we put that into sort of trading systems and stuff like that. Yeah. So this is it. It's right here, and we've got a bunch of courses, and then we've also got code class and trade class, which are live lessons, and over a series of weeks, we'll just guide you through building your own programs and your own trading systems. So that's that. I think what I'm going to do now is I'm going to end the stream, but I hope you learned something about, you know, being efficient in the market and a bit of risk. So I will see you in the next one.